Right, with that, we'll move on to the first big interview of the day. This is the masterclass with Blume Ventures. Joining us is Ashish Fafadia, the partner at Blume Ventures. We've got him because he does seem to have a Midas touch, like the rest of the investment team at Blume. They've got an enviable portfolio. So, Ashish, first up, Happy New Year. Thanks for being a part of Startup Central. You want to tell us a little bit about the year that's gone by, 2019, one of your best years?
Oh, clearly. So we saw a good year in terms of momentum across both the verticals. We had a fair bit of movement in the B2C businesses, which are focused on the Indian markets, and there was a very large uptick in business for the B2B businesses as well. So in overall on the portfolio performance side, we definitely felt that it was one of the best years. A large number of companies moving up into different orbits. In terms of fundraising as well as it resonated, there were about a dozen and a half rounds across various stages of follow-on rounds across the portfolio. And it also was a good year in terms of fundraise for us as a firm. So in the ecosystem also, it was quite buoyant with a large number of unicorns being created, and all of that buoyancy showed and reflected across broadly a few exits and M&As as well. So all in all, I feel that good year for the ecosystem and a decent year for the firm as well.
So a good year is what you've had, and how are you going to top that year in 2020? What's the game plan?
So I think the plan is to keep talking about and working towards performance. There are some fundamental concerns around the broader macro environment. And I don't think all of it is just uncalled for and news. There is a genuine slowness in the way there is money movement happening across the spectrum. But I think when we look at some of the data towards the last quarter of the year, particularly last 2 months of the year, the fall is kind of being stemmed. That leads me to believe that we are fairly close to a point where the overall continuous fall in the market is something that will be plugged in terms of liquidity, etc. In the startup space, I think so far it has not witnessed any challenges on fundraising front or performance front. And the reason on the fundraising front we don't see significant challenges is that any investor who comes and invests in portfolio companies or invests into funds, they take a 10 to 20 year bet on India, and the outlook on India in general has not changed. We definitely have had a weak year in terms of an overall GDP growth. The financial sector and few other sectors have had challenges. That said, the longer term India outlook does not get altered by these momentary spikes. These are part of economic cycles, and when you're talking about unlisted exposure in the alternative asset space, startups and private equity, we definitely feel that there would be challenges, there would be concerns, but fundamentally the long-term views don't change. So what I mean by that is we definitely will continue to see companies that are fundamentally sound, which are focused on metrics, which have genuine moat, where if you have a B2C company, if there is customer loyalty and you are making money off your customers, there is validation of the product, you definitely will see continued growth and momentum. We might not see continued large mega funding rounds, which allowed some very large companies to create capital as a moat. Business differentiation will have to be there. On the B2B front, I think our engineering has come of age, and we are at a point where there is a fair bit of resonance with what Indian tech companies are producing. So on that front also, we don't see much of concern. However, there will be a thrust on fundamental questions, metrics, growth rates and performance, rather than just top line numbers and capital as a moat. Those factors definitely may not be there in 2020. So the way we are preparing for some of these is we have always strongly felt that startups
Interrupt you there.
should.
I have to interrupt you there. I want to interrupt you there because for what you're saying in 2020, that unless you have a startup which is highly differentiated, which is not that Me Too model, is going to be beyond just bottom line, may not see very large fundraising rounds. Why didn't that happen in 2019? Shouldn't that be something that you guys do every year?
No, so I'll clarify. I'm saying businesses, for them to continue to fundraise, they will be backed on strong metrics at the margins level as well as their overall growth. So every business has multiple metrics. It is just not revenue growth. When you are in a bullish phase, when there is a good momentum, one tends to give more preference towards high level numbers and top lines and the overall growth which is possible to buy. For a B2C company, it is possible to invest in marketing dollars and buy some growth in a good year. In a year when capital is scarce, companies are forced to depend on their core metrics and just not burn money very heavily. That's what I meant.
Can you tell me something? You touched upon it very lightly. After the WeWork SoftBank debacle, is capital scarce?
Yeah. Capital, I don't think capital is going to be scarce. It is just going to be coming with lot more accountability and a lot more, I would like to use the word caveats. So I don't think we are no longer in an era of free money to just buy growth. We are no longer in an era where you can say that I'm a startup, I'm a tech business, I have 5 years to prove whatever I want to prove. So no questions asked, just go and capture the imagination of the market. We will have to be more conscious and accountable, and that is the point that I was trying to make earlier as well. As India, we jolly well should do a better job in making sure that we drive our portfolio companies and companies in the ecosystem towards demonstrating sound unit economics, great margins, so that our companies are IPO-able. We may not necessarily take them to the public markets. We may not necessarily be ready today. We might need another 2 years to prepare to take our companies public. But we need to work towards making them IPO-able. This growth has to be sustainable. We can't go for blind growth where a company raises capital, 18 months time, you have run out of money, and only way for you to keep growing, or for that matter, only way for you can sustain is by raising more money. That era may witness some kind of friction in the coming 12 months.
Fair point that you're making. So Ashish, taking forward from the point that you were just making, that era is over where, you burn the cash because you're following your vision. You have to obsess, I think what you're saying, with your bottom line, with the EBITDA, be responsible with the capital, be accountable with the capital as well. It has happened in the post-WeWork era. I want, since I have you today, I'm going to ask you this question. One of the best examples we have of a startup from India that's gone global is Oyo. I'm sure you've read that New York Times article, which what it has, the comments it has from Ritesh Agarwal, the founder. It has Aditya Ghosh, who's now elevated the board position. It's again backed by SoftBank. What did you guys think of it? I'm sure, I don't know if all you investors are on common WhatsApp groups and whether you talked about it. What's been the reaction?
No, so if you meant to ask me the overall direction, I'm happy to share. Anything specific, we're not close to the company, not close enough, so I may not be able to, it may not be fair for me to comment. In terms of an overall direction, I think when you look at the tech investing, I think it's a common strategy for investors to double down on their winners. At times, this gets a little stretched, where investors do tend to come under pressure of making sure that they can salvage earlier investment. So the argument is, are you putting good money after bad? Are you defending your prior investment made, or are you doubling down? So far as I think the investors, in this case SoftBank, I'm sure they know what they're trying to do. So far as I think they are doubling down as a winner, I think all good. We have had a good story. There has been phenomenal execution that goes around building some of these companies at scale. And we can somehow we can defend it with metrics. I think all good. If it's good money after bad, I think at some point in time people will have to account for it and be answerable for it, because there's only so much capital that is going to keep getting into the company. So at some point it will come to a stop. But it's about how investors think about it. I think they know what they're trying to do, is how I would like to put it, because we are not very close to the company.
Fair point. Ashish, before I let you go, I'm going to ask you something. In 2019, I know you love them all. They're all your children. I get all of that. What would you say was your best bet in 2019?
As in best bet that we made in 2019, or something that emerged over the prior years of investing?
You can answer both.
So I think okay. So I think 2019 was a year when we started deploying out of our third fund. And from that fund, there are a couple of investments that have started to take off. There's a agri-supply chain business called Jai Kisan that is starting to do well. It has some traction and spike. Besides that, there were a bunch of investments that we did make. But I would say these one or two stood out. On the prior year businesses, and it was a good year for a business in EduSpace, Unacademy. Rail Yatri also had a good year, both in terms of metrics as well as fundraising. Grey Orange, which has been our biggest winner so far, continues to move well. Purple, which is a beauty cosmetics business. So I think these are the 3-4 companies right at the top which come up there. And 2020, we do see some of the other companies taking forward. There's a fintech business in insurance called Turtle Mint. We expect that business to raise a very significant round in the coming years, coming months. So I think these are the 4 or 5 companies from our stable on the growth side which are doing incredibly well. And on the early stage, as I mentioned, Jai Kisan, there's another business. So it was a year where we made about 10 or 12 investments. They're early stages. I would have to wait for some more time to announce them. But yeah, these are the few businesses that did well.
Thanks for being candid on this one. I'm going to ask you another one, that any mistakes or anything that you didn't do, an opportunity that you had, which you now look back in 2020, I'm talking about 2019, and say, damn, I missed that one. Because you learn from your mistakes, right?
Well, of course, yes. So I think we do end up losing investment opportunities. We do end up passing on them. 2019, I would have to wait for some more time. For what you're referring to is, can we call out an anti-portfolio from 2019? I think it's too early for me to call out an anti-portfolio from the 19 period of 12 months. But in the past, we have had misses. We had opportunities to look at even Oyo, and I think we didn't go ahead with it for various reasons. So I think, yeah, we do make our own decisions. When they grow big, it looks like you made a mistake. So far as we know why we did that and how we can make sure that we don't lose a unicorn, I think we are learning. I think it's all good. So far as we don't lose lesser than what we have invested and can make a 4 or 5 bagger on our fund to our investors, all good.